Hello there, you're watching Dukascopy TV, and Latin America is the first stop of the day. Several days ago, a report came out in Brazil which showed the end-of-year inflation rate standing at almost 6%. The markets hadn't really priced in such a rise, and for the president of the central bank, Alexandre Tombini, not the sort of news he will have been pleased to wake up to. Well, on the line to discuss all this and South America in general is Harish Natarajan, analyst and specialist on South America. Harish, welcome to the programme. Now, we know there's been a decline in investment in some of the world's emerging market countries, but the latest concern to hit much of the South American continent lies in currency depreciation, doesn't it?
Absolutely. What's been happening in the last year in particular, and mainly since May, have been concerns which have been raised by the end or the decline of U.S. quantitative easing, with the plan being that the Federal Reserve in the United States will start scaling back quantitative easing measures this year. The consequence that is having is there is going to be less and less cheap credit flowing to emerging markets, and this is having a large effect on several countries, Brazil being one of them, but by no means the only one, and several other Latin American countries also being hit.
Now, if we take Brazil, for example, currency depreciation has been blamed for the rocketing inflation there. Argentina and Venezuela have already suffered under a depreciating currency. Just how much could this issue of a deflating real have on Dilma Rousseff, the current president of Brazil, and of course the imports there?
It's actually a very interesting issue. To some degree, I think it's often overemphasized how large the problem of the depreciation is. If you cast back your mind to 2010 and 2011, most people were claiming that the Brazilian real was massively overvalued. So to some degree, the depreciation is a correction. However, the fact that the currency depreciated by close to 13% last year and may well depreciate by a similar amount this year will cause several problems. The first is skyrocketing inflation. If you look back at the protests in Brazil mid last year, you saw one of the things people complained about were high costs of living. That is clearly one of the issues which will be again an issue if the depreciation of the real continues. And with elections coming up in less than a year, I think this will have very significant consequences to an already unpopular president. The good news for the country, though, is that there does seem to be some concerted attempts to deal with the problem from the central bank governor. That you saw, for instance, a half-point increase in the interest rate, which looks to be a sign of commitment that they will try and get inflation under control. And one way in which they'll do that is trying to stabilize the currency.
Just how long then will it take for emerging market countries like those in South America to wean themselves off dollar-denominated lending?
I think it's a very interesting question, and to some degree you'll never fully be able to wean yourself off dollar-denominated lending. One of the simple reasons for that is getting loans in US dollars is often just much easier. The US dollar is far more liquid, and investors are always much more likely to be willing to lend to you and get money back in US dollars than in other currencies. But I think one interesting trend is that over the last 10 years, there has been a reduction in the amount of US dollar-denominated debt in South and Central America. From up to about 50% of debt in the turn of the century was denominated in US dollars. Now it's probably in the region of 30%. Still very high, but certainly showing the possibility of reduced dependence on the US dollar and US denominated debt. I think you'll see more and more of that occurring, though the US dollar and dollar-denominated debt will still remain very important, both for sovereigns and for corporations, and may become less important over the next 5-10 years, but it's a long-term rather than a short-term process.
Finally, Harish, just how big a problem is foreign currency debt in South America right now, and are investors hindering rather than helping the situation?
In terms of how large of a problem it is, there's multiple different schools of thought. My opinion is, even though the importance of US dollar-denominated debt has decreased in the last decade, it is still very high, which implies that a large depreciation of the Brazilian real, the Mexican peso, or any other similar currency will have a large impact on those economies and the ability of them to get further debt and service their current debt. That is going to be a problem, and in many ways it will be the greatest concern of the depreciation of currencies, which went on last year and which will continue this year. In terms of whether or not investors have hurt or are helping the country, I think obviously the answer is a little bit of both, which is cheap debt has been incredibly beneficial to fuel investment spending, but in many countries that has just been so inefficient over the last 3, 4, 5 years that it never had quite the returns which it could have. I think further investment could be very beneficial to the country, but the question's almost always political, which is how efficiently is the money going to be spent? If spent well, the downside risks of having large amounts of foreign debt will probably be outweighed. When not spent very well or spent inefficiently, as much of the money which has come in over the last 5 years has, it clearly doesn't have those same positive impacts. So the important variable is how the money is going to be spent, and that will depend on the country and will depend on the political system and particular parties in place.
Okay, thanks for joining me today for the latest financial news and opinions on South America. I'll be back tomorrow with a look at the US, but for now, bye-bye.